Are you a first-time home buyer and you're finding it super frustrating to get into the real estate market? I too was once in your position, so I definitely understand how you're feeling. That's why I made today's video, because I want to help you get into the market as quick as possible. Welcome back, it's Tom here from Moffett Mortgages. Thanks again for tuning in. I'm excited for today's video because I do see a lot of my clients in the same boat as you. When it comes to trying to get into the market, it's super frustrating. The listings are down year over year by a lot, depending on what province you're in. So I really want to make this video to be as helpful as possible to allow you to shave off some time in terms of trying to get into the market. So let's dive in with the first point. Start off small. So what I mean by that is, I know it's very appealing to have the fully detached house with 2-car garage, big backyard. Maybe you do have a family, you do need the room. However, it may not be realistic to go that route in terms of buying your first home. With the real estate prices how they are, at least here in Ontario and even BC, you might want to start smaller by purchasing, for example, a 1 or 2 bedroom condo. Now again, this all depends on the size of your family. So obviously if you have 2 or 3 kids, that may not be realistic, but you get my point. Try and start a bit smaller if it's feasible for you and your family, which allows you to get into the market a lot faster, and it will allow your house to appreciate over time, which ultimately helps you climb the property ladder. So for me personally, what I did is I bought a 628 square foot condo downtown Hamilton, Ontario. And it was a small condo. It was actually technically a studio. However, it allowed me to get my foot to the real estate market. And from there, 2 years later, I had some built up equity and I was able to transition to a townhouse. So that's just my example. Maybe you don't go that route to that extreme. However, you get my point. Just try to start smaller because it allows you to get into the market. Tip number 2, stop saving for a 20% down payment. If you're sitting there and you're one of those people that are saving up for a 20% down payment, please just stop. With how inflation is and the appreciation of the real estate market, you're ultimately going to get behind by trying to save up for that 20% down payment, because you're probably thinking that you want to save on mortgage insurance, which I totally get. It's not cheap. However, the cost of mortgage insurance is definitely outweighed by the appreciation of your home over time. So let's say it costs you $30,000 in mortgage insurance. Now, if you don't know what mortgage insurance is, definitely check the video up above where I break it down and make it very simple to understand. But if you haven't seen that video and you want to keep continuing watching this, just know that anytime you put less than 20% down, you're paying a premium because you have to pay for mortgage insurance. Now that premium is essentially added to your total mortgage amount. So let's say you're paying $30,000 for your mortgage insurance. That is added onto your mortgage amount. So you are not paying for that upfront. It's simply tacked onto the mortgage and you're not having to pay that upfront. So going back to my point, if you have 5% down and you can afford the house that you want, well, definitely do it. Definitely get into the market. Now moving on to tip number 3, get a gift from a family member. So if you don't have a down payment, one option is to actually get a gift from a family member. So what a gift is essentially if a family member wants to give you money to help you purchase a home, they can give you, let's say for example, it's $50,000. They can gift you that $50,000 as long as you're not giving that back to them after closing. You can use that towards your down payment. Now, if you're thinking that your family members don't have the luxury of gifting you your down payment, I totally get that. Not everyone has that luxury. However, there are some ways that family members can access money to gift to you. So for example, they can do a mortgage refinance, which essentially is restructuring their current mortgage and tapping into equity in their home. They can do that if they want to go that route. Of course, it can be a big deal for some people, but that's an option. You can also use a HELOC, so a home equity line of credit, which is essentially like a line of credit, but it's registered against your home at a lower interest rate. They can access that to gift you the money. And thirdly, what's actually becoming pretty popular these days is they can do what's called a reverse mortgage. So essentially what a reverse mortgage is if they want to tap into their equity in their home, and let's say they're free and clear of a mortgage on their home and they don't want to have any monthly expenses from that new mortgage payment. For example, if they're refinancing, they're going to have to pay a monthly payment. But with the reverse mortgage, they can tap into that equity without having monthly payments. It's also known as an equity mortgage. So they can go that route as well. That's something to talk about with your family. Maybe they can, maybe they can't gift you the money, but if they can, that's definitely going to give you a leg up in terms of getting into the market faster, finding a property that might be one level higher than what you're currently looking for. Or even if you have, say, 15 or 17% for a down payment and you're just right there for 20%, well, these options can ultimately help you get to that 20%. And what that will do is once we get to the 20% down, we can stretch your amortization to 30 years, which ultimately allows us to borrow up to 7 times your household income, versus when you're putting less than 20% down, you're stuck with a 25-year amortization, which ultimately allows you to borrow up to approximately 5 times your income. So tip number 4, get a cosigner. If your income levels are what's holding you back in terms of getting the pre-approved amount that you're looking for, well, you can bring on a cosigner, a family member, to help you qualify for the loan amount that you need. Essentially, when we're taking on a cosigner, we're taking into account their income and any liabilities they own. So for example, if they have a mortgage or they have any car payments, we do have to account for that in the application, but more times than not, it definitely helps you boost up the pre-approval amount, which of course helps you have a more competitive edge when it comes to getting your offer accepted. If you're wondering how co-signing works and how that affects your family member when they go to co-sign, definitely check out the video above as I go into detail as to how that affects the family member going forward when they're co-signing on your mortgage. Tip number 5, get pre-approved the right way. So if you're out there with your realtor house hunting, but you don't have a pre-approval in place, well, that's definitely something you want to get. Out of all tips today, this is a must for you. But not only do you need a pre-approval, you need to get the right pre-approval. So what I mean by that is whoever you go to, just make sure that they're looking at all your documents up front. So documents such as your income documents, like your T4s, your pay stubs. If you're self-employed, it would be your T1s, your NOAs. If you have a down payment from savings, they're going to be looking at your bank statements. They're also going to be pulling your credit. Now, if they're doing none of these, then you definitely want to see someone that's doing it properly and they know what they're doing. So I've said this in many videos, and again, this is no hate to the banks, but this is often what happens when you do go to a bank is typically they may look at a pay stub and they may ask you how much you make and they may ask what your credit score is. They may pull it, but what I'm trying to say is their upfront pre-approvals just aren't as solid as what mortgage brokers do. So we see from time to time, again, we see clients come to us after getting pre-approved from their banks and they put in a subject-free offer, but they don't have the financing from the lender that they went to originally because they couldn't get it done. They never got the full pre-approval up front. So ultimately they needed to go to a mortgage broker to seek alternative financing, unfortunately. So that's why it's super crucial that you get a proper pre-approval. If you're curious as to what a pre-approval looks like, definitely check the video up above as I go through in that video. I walk step by step as to what a pre-approval looks like and what you should be looking for. If you want to start the pre-approval process and find out how much you can get pre-approved for, click the link down below to my online application, or you can book a call with me down below as well, and we get the process started. So there you have it. Those are my 5 tips on how to get into the market quicker. Now, I hope these tips shave off some of the time it takes for you to get into the market. And please just, if you are out there shopping and maybe you're on your 5th or your 6th home that you're putting an offer in, I know it can get discouraging, but please just know that you will get it eventually if you're persistent. I've had clients in the past where they put in 10 to 15 offers until they finally got their offer accepted. So best of luck, and I'll see you on the next video.